Hello and welcome to the Providence Investment Update for January 2024. My name is Michael Ogg. I'm joined here by Marc, Head of Investment Strategy at Providence. Welcome, Marc.
Thanks, Mike.
Now, Marc, I'll start off with the first question I always ask, which is the title of the Global Outlook and Strategy. And this time it's past the peak. What peak are we past?
We probably could have called it twin peaks, actually. So the first peak that we'd say we've passed is those very elevated fears around inflation that we had at the start of 2023. Expectations, sort of inflation tracking at close to 8% in the US, and potentially there's going to continue to be a persistent problem. And we've seen inflation start to come down, and whilst it's still above the central bank's target, if we look at measures like core PCE, they're tracking at 2.9%, unit labour costs are tracking below 2%, and actually productivity has been quite strong in the US, which has been a nice turn because we've been through a period of time when productivity had been quite low. So that's been a very sort of positive development on the inflation front. The second thing that we'd point to in terms of our second peak is around interest rates. So we had tremendous volatility in 2023, both in expectations of where the Fed might take rates. Some forecasters talking about potentially having to go as high as 7%. And we've also seen that feed into the bond market. So bond yields were exceptionally volatile last year. Measures of volatility like the MOVE index were particularly elevated at levels not seen since the global financial crisis. And that created a lot of uncertainty. So essentially it put a lot of nerves in the market. And so we'd really want to signal with that title that we've kind of moved on from that environment.
And Marc, with this moderation of inflation and interest rates potentially peaking out, what impact is that having on investment markets? And has that already happened? Because we have had a rally in the last quarter.
Yeah, so I think it's a good point, Mike. So in a way, you'd say for some parts of the market, potentially it has happened. So if you look at the Magnificent Seven, they were up around about 102% last year. So those markets did very well. If we look back to what's the implication, well, the implication is less volatility in interest rates, potentially the ability for multiples to expand in the equity market. I think the second thing is where there were concerns of sort of heightened financing costs with a view to central banks easing policy in the year to 18 months ahead, less pressures on companies around the cost of financing. So that should help the equity market. And then third of all, I think a little bit more security of income in some of those defensive asset classes like fixed income.
And Marc, geopolitics seems to be on the front page of the newspaper, every day now. What impact do you think that will have on inflation?
Well, why don't we kind of list what the key focuses are for the markets, because I think that's important. The first thing is obviously the Ukraine-Russia war. The second one is the Israel-Hamas war. The third one is the recent developments in the Red Sea, where a number of sort of oil and container ships have been attacked by the Houthis. And then the fourth one that kind of continues to simmer in the background is the great sort of power struggle between the US and China, with a sort of discussion being around will they or won't they invade Taiwan. So I think all of those things are sort of front of mind for people. And what we'd say is potentially whilst there's less fears around volatility of inflation and interest rates, the baton's been passed to geopolitics. The other thing I'd say is the flip side of the coin is, as you say, it's on the front page of the paper all the time. And so people kind of know about those concerns and are pricing in those concerns. Needs to be very careful not to sort of dismiss them, but sort of keep them front of mind, but also view what potential are they already in the price.
Well, just moving to markets again, the IPO market seems to be breathing some life into it at the moment. What impact does that have on asset classes?
So that's a really important development because we've essentially had a freezing in the capital markets activity for the last 2 years. There hasn't been a lot of sort of low quality debt issuance in the US. There haven't been a lot of IPOs that have successfully debuted. And we're starting to see that dynamic turn as there's less concerns around inflation and interest rates and investors have come back to the market. I think the second thing we'd point out is that there's a lot of cash sitting on the sidelines. If you look at money market fund balances in the US, they're at very elevated levels at this point in time. So there's potentially some supportive tailwinds. So as the capital markets reopen through equity issuance and debt issuance, we'll start to see some freeing up in those asset classes that have been most affected by that freeze. And front and centre is really private equity, venture capital, and then potentially also real estate. So we'll start to see a little bit more movement in those types of assets where we've seen a lot of sort of fund extensions in venture capital, private equity firms continuing to sort of bring up these continuation funds to try and extend the life of the assets that they own. And I think the IPO market just provides an opportunity for some of those assets to be sold, cash to be returned to investors, and for markets to be a little bit more free in terms of where they move forward.
And Mark, just moving to Japan for a second. Japan has been in the doldrums for a long time. This year they performed very well. There seems to be a lot of changes in Japan. Can you just summarize what's going on there?
Well, I think we've been very positive on Japan for an extended period of time, and it's served the portfolio as well. The dynamics remain quite positive. I mean, the first thing, if we look at valuations on a 2-year forward basis, the broad Japanese topics index is trading at around about 13 times earnings, which is a pretty modest valuation when you look around the world, particularly when you compare it to something like the NASDAQ in the 20s or the S&P in the high teens. It seems reasonable. The second thing is Bank of Japan has had extremely easy monetary policy. Now that may change and there may be some sort of movement around the edges, but we don't see the Bank of Japan moving to an overly tight policy, so that's okay. And then the third thing that's happened is there's been some very big corporate reforms. So the Tokyo Stock Exchange came up with sort of a with cause notice for companies trading at less than 1 times book. Companies are very focused on returning cash to shareholders, whether that be through share buybacks or dividends. Companies are being pushed to perform at a higher rate and be more shareholder friendly. And then interestingly, in the background, we've also seen an increase in private equity activity in Japan. So I think Henry Kravis recently was quoted as saying, if he was in his 20s, the first thing you do is jump on a plane to Tokyo because there's so many opportunities there where there's some great companies that private equity can really fix. And as they sort of come off the bourse, they'll typically come at a premium when the private equity buyers buy them. So that'll help the market as well.
And Mark, this final sort of big question, given the inflation backdrop and geopolitics, where are you seeing the risks and where are you seeing the opportunities?
Yeah, so I mean, I think the risks are right to frame them around geopolitics. And that would be most acute around elevated energy prices, because obviously that's a big tax on growth, potentially an inflationary pass-through. So were we to see energy prices fly higher for an extended period of time, that could bring back a little bit on the inflation front. I think the other thing in terms of risk is, as we see this price discovery in some of these stock markets, it's not all going to be good news. There'll be some good companies that move forward. Potentially in venture capital space, there'll be some other companies that become zero. Same, I'd say, in commercial real estate. There'll be some parts of that market that will be very good as the sort of ownership of those assets change hands, and there'll be opportunities to improve those assets and move them forward. But there'll be others where there'll be difficult work to do around coming up with a reasonable valuation for areas like B and C grade offices.
And the opportunities?
And I think in the opportunity space, if we look at the sort of chart around the dispersion of equity markets and the pricing of dispersion around equity markets, and you can see on this chart, there's actually a wide variety of PE ratios across markets around the world. So we'd point to Japan, we'd point to global mid-caps. I think there's some interesting things in sort of the emerging market space as people worry about some of the developed markets with the debt burdens. In terms of harvesting yield, we think that's an important dynamic as well. So if you look at sort of the bond markets with positive real yields, a 4% nominal yield is a much better place to be than a 1% nominal yield for bonds. Seeing some opportunities in credit, particularly in private credit where yields are sort of high single digits to low double digits. And we think in an environment of sort of interest rates starting to come down, it's going to be quite a positive environment for that harvesting yield thematic.
Mark, thank you very much for your time.
Thanks, Mike.
And thank you for joining us. I hope you enjoyed the discussion, and we look forward to sharing our views and ideas in the next quarter. Until then.